Okay, folks, welcome back. This is lesson 5 of the June 2017 ICT Mentorship, using options and stocks. Obviously, we mentioned there are major market turning points and timing for buy and sell programs for stocks. And we look for February to May for our buy programs for buying stock or stock options. And we look from May going into the second half of September for our shorting of stocks or long put options, which is the equivalent of going short. And then we look for, again, around the last portion of September, beginning of October, till the end of the year, where we are bullish again on stocks. We look for reasons to buy stocks and or long call options. When it comes to options trading, I like to keep it simple. I tried very hard early on in my career to delve into the Greeks, doing all kinds of exotic things with options, and admittedly it became very daunting, and I became overcomplicated. And some of you have gone through my content and your heads are spinning sometimes with the depth of information and almost information overload. The idea is, when we're using options, I found that the simplest is the best, and I've always stuck to tried and true option strategies, which is simply the long call option and the long put option. The first we're going to look at here is the long call, and this is your right but not obligation to own 100 shares. So every option gives you the right but not obligation to own 100 shares at a specific price, and that price is the strike price. Okay, and since theoretically there can be no limit as to how high the stock price can go before expiration, because all options expire, they have an expiration date. There's no limit on how far the stock can go. It's just a matter of how far will it go before your option expires. Since there is no limit, and that means you have a maximum profit potential that's unlimited. The long call option strategy, ideally, if used in the February to May portion of the year and October to the end of the year, that's your primary go-to. Now, in August, I'm going to talk about doing covered calls, and it's too much for this topic here because I got to go into a little bit more detail with other things. But there's another strategy that I do that, and I do bull spreads. So, and I'll talk about them also in August content as separate topics. So, in the month of August, when we do our teachings, while you're only going to get really 4 lessons in detail, like we're getting normally 8 per month, you're only going to get 4 for the month of July and 4 for the month of August. But during the live sessions and during market commentary, I'm going to be talking about and giving you information about other things that I've done as a trader, and is best of my ability believes that it's of value to you or anyone else that would consider delving into it. So, but for now, I want you to just focus on the 2 simple strategies here, the long call option and the long put option. So, and you're using the long call option, the maximum profit, obviously, again, is unlimited until expiration. Then how do you make money? Well, the call option, for instance, you have to be bullish on the market. And if you buy a long call option, the easiest way to remember it is a call option is to call up, means you want to see price go up, and put down is when you want to see the market trade lower. If the market moves in your intended direction, in other words, a long call means that you're bullish on price. If you buy a strike price and it's next to the market price and it goes higher, theoretically your option can be profitable. Not always, but generally that's what we're looking for. The risk that's associated with long call option strategies is limited to whatever the price you paid for the premium and the commission costs. So whatever your commission costs would be, maybe it's $5 per contract. I don't know. I have no idea what your option commission would be based on who you're trading with and who your broker would be. But it's not really expensive. It's not much money at all. But the risk is limited to whatever the premium paid. In other words, if you're looking at a stock option that has a premium of 2.5, every option gives you the right but not obligation to own 100 shares. So if it's 2.5 and the multiple is 100 shares, you're paying $250 for that option. Plus commission, we'll say it's $5. Your total cost would be $255. That's the maximum you can lose. There's no other way you can lose money. You cannot lose any more money than that. Now, the wonderful thing is you have unlimited profit potential. To me, that's worth weight in gold. If we know that we have a strong tendency to see bullish prices in February into May, and then in October at the end of the year, it's a no-brainer. We understand what makes these seasonal tendencies work. We understand how to ferret out the strong stocks. We know what the smart money index S&T looks like to confirm all that. We can find leadership issues in index trading and now valuation using CAN-SLIM ideas. The world is your oyster when it comes to trading those 2 times of the year with the stock market. If the market's bullish, it's very, very easy to go through and find a handful of stocks that could potentially pay out well in terms of premium yield. So when we buy the call option, we're looking for cheap options, not very expensive options, and we're looking to either double our money or triple our money. So if we paid $250, we're trying to make $500 or $750. Nothing more than that. And if you do that consistently, year after year after year, you can do very, very well and compound your income. Let's take a look at a hypothetical example. Now, suppose the stock of ICT company is trading at $50 a share. A call option contract with a strike price of $50 expiring in a month's time is being priced at $2. So the premium is $2. You believe that the ICT stock will rise sharply in the coming weeks, so you paid $200 to purchase a single $50 ICT call option covering 100 shares. Now, suppose the price of the ICT stock rallies to $60 on option expiration date. With underlying stock price at $60, if you were to exercise your call option, that means you're telling your broker that you want to own those shares now that it's $10 in the money. You want to own them. So it says basically, okay, now we're going to say you bought them at 50, but you're not under on the obligation when you first buy the option. But when it's in your favor, you can exercise that option, and the strike price you bought, that becomes your entry price. In this case, if you were to exercise your call option, you would invoke your right to buy 100 shares of ICT stock at $50 each, and you can sell them immediately in the open market for $60 a share, thus giving you a profit of $10 per share. Now, as each call option contract covers 100 shares, the total amount you would receive from this exercising of the option is $1,000. Now, since you had paid $200 to purchase a call option, your net profit on the entire trade is therefore $800 less commission costs. In this instance, if it was $5 per round turn or your commission, then it would be $795 net. Now, however, if you were wrong in your expectation and the stock had instead dropped to $40, your call option would expire worthless, and your total loss would be $200 that you paid for the purchase of the option plus commission costs, or in this case, $205 if $5 was your round turn commission cost. Okay, the second option strategy I like is the long put option. And this is when we're bearish from the marketplace, we're directionally driven, and that's going to be between the months of May going into the half of September. So if we're bearish and the market generally is going lower, we can expect to see lower prices there. Index S&T is diverging and showing stocks that are failing to make higher highs. All the things we talked about previously. We could be looking at potentially a stock that can go down to zero at expiration. There's nothing saying that it can't go down to zero. We've seen stocks that do that. So if we see the stock price, in theory, can reach to zero by expiration date, the maximum profit potential that's possible when using the long put strategy is only limited to the strike price of the purchased put, less the price paid for the option. So the maximum profit is, again, unlimited in the scope that you can make as much money as possible until the stock goes to zero. And the profit is achieved, obviously, by seeing the share price drop below your strike price that you bought for the put option. So if you think prices are going lower for a specific company, you buy as close as you can to at the money or where the price of the shares is trading at. And as the share price drops, as long as the price of the underlying stock price is below your strike price on your put option, you are theoretically in the money. Now, it doesn't mean you're seeing profits, because there's going to be times where you bought the wrong stock put or you're in the wrong strike. or the options are overvalued, which I'll give you reasons why I think it's easy to find undervalued stock options in our last slide on this teaching. But the maximum loss is your premium paid and the commission. You cannot lose any more money. The stock could go up $1,000 per share from wherever you bought your strike price at. Doesn't make a difference. You can only lose what you paid the premium of plus your commission. But you have very, very large potential profit. And if we've seen how many times we've been able to call significant price moves in the stock market as a whole, and then ferreting out weak and strong stocks. In this case, we're looking for a weak stock in a weak market and with downside potential. Looking for a long put option. Long put means that you're trying to make money when it's going down. Basically, it's like selling short the market with guaranteed risk set to a specific amount that cannot ever be exceeded. There's no slippage that's going to happen. That's the maximum. You can't lose any more than the premium you paid plus the commission. That's the reason why I've always taught that traders should be using long puts and long calls, because it limits your risk. There's no other medium out there that I think that has that much of a bonus. There's no other investment vehicle, I believe, that has that much of a potential where we can go in, predefine our risk. The sun could not rise tomorrow, okay? And the worst thing you're going to do is see the loss of the premium paid plus your commission cost. And it's very hard to find that type of scenario outside of options. Okay, so we're going to look at a hypothetical example here again. We're going to suppose that the stock of Trolls Company, TRLZ, is trading at $40 a share, and a put option contract with a strike price of $40 expiring a month's time from now is being priced at $2. So you believe that the TRLZ stock will fall sharply in the coming weeks, so you paid $200 to purchase a single $40 Trolls put option covering 100 shares. Now suppose the price of Trolls stock crashes to $30 at option expiration date. With the underlying stock price now at $30, your put option will now be in the money with an intrinsic value of $1,000. And you can sell it for that much. Since you have paid $200 to purchase the put option, your net profit for the entire trade, therefore, is $800 less commission cost. Or in this case, again, it would be $795 if your round term commission cost was around $5. Now, however, if you were wrong in your expectations and the stock had instead rallied to $50, your put option will expire worthless, and your total loss will be $200 that you paid to purchase the option plus commission costs, or $205 again if the commission cost is around $5. So we've mentioned two things here. We've talked about intrinsic value, and there's an element of time that's necessary. Okay, we're looking at an option example in both the long put and long call with about a month's time. I generally like to see a little bit more time than that, and intrinsic value is what the value of the underlying is in relationship to the strike price. There may be a difference between where you entered the option. In other words, if you went short the stock by buying a long put option at a strike price of $40, the stock could be dropping to $25, but if there isn't much time before expiration, you may not be seeing profit. So the intrinsic value, while it would be otherwise good, because of time decay, you're not making any money. So you have to beat the clock, and you have to beat the market. So that's the reason why you had to look at times where we went through all the information regarding seasonal tendencies, SMT divergence with the major indices, and then looking for leader and laggard stocks in the index groups. So now, having that understood, let's take a closer look on what you have to consider in terms of what strike price and what expiration. So what option strike price and what expiration should you use? Now the strike price is what option price you're going to be using. If I see a stock that I like, that is going to be a mover one way or the other, whether it be bullish or bearish, number one, I have a preconceived notion that paying more than $350 an option is just stupid. Okay, there's plenty of traders out there that pay a lot more for options, and they do all kinds of option trades, and they can do that and make their career out of it. I just don't like it personally. I want to find trades that pay out very well, very low cost to get in, and if I'm going to do the work and go through all of the information that I've been sharing with you all, I believe that I'm going to find some really good blue light special deals. So I like paying no more than $350 per option, and this means the premium is going to be 3.5 for the strike price that I want to purchase. Now, this is either call or put option. So ideally, we can see premiums in around 1 to 2 per contract, or basically meaning $100 to $200 per option. Now, if I can buy close to the money options, that means 1 to 3 strike prices away from the market price. That's a blue light special or cheap option purchase. I will load the boat in that condition. The option expiration, I want more than 90 days until expiration. Okay, I know that time decay will build as we get under 75 days until expiration. So if I have about 2 weeks, I'll be able to see whether this position is going to grow in its premium. Okay, in other words, what I paid for it, am I starting to see that premium increase in value? Because I'm going to be fighting intrinsic values growth versus time decay's loss of premium. So it's a tug of war that's going on there. I want something that's over 90 days, because once we get around 60 days or 65 days of until option expiration, the effects of time decay really take a major toll on the premium of the options. And that's why most options expire worthless, because of the effects of time decay. And without knowing the things I've taught in terms of directional and timing of the stocks, you can see why that writing options or selling options is actually many times the better condition. But if you don't know what you're doing, you can get really hurt selling options. So if I have about 2 weeks to see, by having an option that has over 90 days expiration, until I get around 75 days until option expiration, I can see the effects of whether the market's going to start seeing that premium increase. And if it doesn't, hopefully that'll give me an opportunity that I can sell it before expiration and avoid a major premium loss due to time decay. When we go through the fall months, even post mentorship, I'm going to actually do the fall top-down analysis right in front of all of you, so you can see what options I'm looking at, which ones I like, what options for the call options I like for the leadership issues I think is going to be a buy in this fall. And even if the market does crash, there's going to be opportunities for us to see long opportunities, because I think we'll see something of bullishness this fall. And I'm going to outline everything that we can see, the whole thing from top down to expiration, and the strike prices that I like for each individual stock. But without having an example of actually doing it, you'll learn better by watching me do it. But this is theoretically all that I look to do. It's not hard. It's rather simplistic, but you can actually go through, go to YouTube and watch a couple things on long calls and long puts. And there's a lot of guys that have done really well in terms of producing tutorials that help you familiarize yourself with more details about what makes these two option strategies simple, but sufficient enough to make money. So until next time, I wish you good luck and good trading.